Every government loves the idea of control without responsibility, the power to shape the economy without being blamed when it breaks. That is the hidden temptation behind currency boards. On paper, they look like the closest thing to monetary perfection. No money printing at will, no late-night political meddling with interest rates. A hard rule: every unit of local currency is backed by a unit of foreign currency. Simple, disciplined, stable. But there's a darker side hiding underneath the stability, because when a country locks its money to someone else's, it does not just gain their stability, it also inherits their crises, their interest rates, and their political choices. It gives up the steering wheel and hopes the road stays smooth. It trades flexibility for faith. And when the world shifts under its feet, those same rules that once looked like protection start to feel like handcuffs. The thing that kept panic away in calm times suddenly starts amplifying the pain in a storm. This is the quiet story of currency boards. Stability with shackles. To understand how a system that looks so clean on paper can lead to such brutal outcomes in reality, it helps to go back to the beginning, to a time when one empire tried to control the edges of its world with pieces of paper backed by promises from far away. In the late 19th and early 20th centuries, the British Empire faced a problem most modern global powers would recognize. It ruled territories scattered across Africa, Asia, and the Caribbean. These colonies needed money people trusted to trade, save, and pay taxes. But London did not want every local governor improvising their own experiments with money or quietly printing their way out of trouble. The solution it developed was simple, elegant, and deceptively strict: the currency board. In a colony like Hong Kong or Malaya, an independent board would be set up to issue local notes, but those notes were not backed by vague promises or political speeches. They were backed one-to-one by British pounds held in reserve, often in London itself. For every local dollar printed, there was supposed to be a pound sitting behind it. If someone did not trust the local paper, they could, at least in theory, trade it back for something anchored at the heart of the empire. The message was clear: this is not just some fragile colonial script. This is a shadow of the pound. That design accomplished three things at once. First, it created automatic discipline. The local authority could not simply print money to pay its own bills or bail out favored businesses. It could only issue currency when it had the foreign reserves to back it. Second, it extended British monetary power across oceans. If London raised interest rates or tightened credit, the effect would eventually ripple through the colonies through the peg. The empire's heartbeat pulsed through distant economies. Third, it shifted responsibility. If something went wrong in a colony, local officials could always say, "Our hands are tied. The rules decide, not us." The pain felt local, but the rules looked foreign and mechanical. Currency boards were built to solve a political problem using a mechanical answer. No debate, no discretion, just a rule. But when a country builds its entire economy on rules that are rigid, it is making a trade it may not fully understand. It is buying trust from the outside world and paying for it with its own ability to adapt. To see how this works in practice, it helps to strip away the romantic language and look at the mechanism itself. A normal central bank has tools. It can raise or cut interest rates. It can print money to buy government bonds or inject liquidity into the banking system. It can quietly devalue the currency or allow it to float when foreign conditions change. It may abuse those tools, but it at least has them. A currency board is more like a machine locked in a glass box. It has one primary rule: for every unit of local currency in circulation, there must be a unit of foreign reserves behind it, usually dollars, euros, or another trusted currency. The exchange rate is fixed, not managed, not flexible, not somewhere in a band. Fixed. If the peg is set at 7, 8 local units for $1, that is the promise, the board stands ready to give dollars at 7, 8, and to accept dollars at the same rate. No negotiations, no mood swings, just the rule. That rule means something important. The board cannot freely create money. If it wants to expand the money supply, it must first receive foreign currency. When money flows into the country through exports, tourism investment, or capital inflows, the local money supply expands. When money flows out, the local money supply contracts. The board does not steer the economy. It simply translates external flows into internal money. It turns the country's banking system into a mirror of the outside world. That is the source of the stability, and that is the shape of the shackle. The system gives the country the credibility of the anchor currency without the constant temptation to quietly debase its own money, but it also takes away the ability to respond when the economy is in pain. If banks are suddenly in trouble, the board cannot just print emergency liquidity. If unemployment spikes, it cannot simply cut interest rates to stimulate demand. The health of the domestic economy becomes a secondary concern. The primary concern is protecting the peg. So why would any government voluntarily agree to live inside those constraints? The answer usually appears in moments of desperation. Currency boards are not typically adopted in calm, prosperous times. They appear after chaos. Think of countries emerging from hyperinflation, financial collapse, or political breakdown. Their own money has become a joke. Prices change daily. People start pricing goods in dollars or euros because nobody trusts the local money. Savings have been wiped out so often that entire generations flinch when they hear the word reform. In that situation, a government saying, "Trust us, we will behave better this time," means almost nothing. A currency board offers something different. It says, we literally cannot cheat because the machine will not let us. The government is putting itself in a monetary straitjacket on purpose and handing the key to the outside world. That was the appeal in places like Estonia in the early 1990s, emerging from the ruins of the Soviet system. It was the appeal in Bulgaria in 1997 after hyperinflation. And it was a big part of the story in Argentina in the early 1990s after decades of inflation, devaluation, and broken promises. These countries did not just want stability. They wanted a signal. They wanted to show investors, businesses, and their own citizens that this time was different, that the old game of printing away problems was over, that the currency in people's pockets now had real backing. In the beginning, it often works. Inflation collapses, prices stabilize, imports become cheaper. People can think in terms of years instead of days. Foreign money flows in because the peg is a comforting promise. Growth surges. Politicians point to the calm numbers and declare victory. But the same set of rules that restore trust in the short term also reshape how crises unfold in the long term. The bill for stability does not arrive right away. It arrives later, with interest. Argentina is a brutal illustration of that delayed price. After years of inflation and distrust, Argentina effectively adopted a tight currency board in the early 1990s. 1 peso, $1. Every peso backed by a dollar. No more surprise printing, no more stealth taxes through inflation. For a time, it worked exactly as advertised. Inflation plunged from triple digits. Middle-class Argentines could finally save in their own currency. Investors believed the story and poured money into the country. To many, it looked like a broken economy had found its cure. Borrow the credibility of the US dollar and ride it to stability and prosperity. But the peg came with strings attached. Argentina's economy now had to move in step with America's. When the US dollar strengthened on global markets, so did the peso. When the US raised interest rates, Argentina had to shadow those moves to defend the peg, even if its own domestic economy was already under strain. Meanwhile, Argentina had its own cycles, its own shocks, and its own politics. As the years passed, the mismatch became painful. Exports suffered because the strong peso made Argentine goods more expensive abroad. The government and many firms had borrowed heavily in foreign currency during the good times. As global conditions shifted, that debt got harder to service. Unemployment rose, growth stalled, social tension built. Under a more flexible system, the central bank might have chosen to let the currency drop, accepting a controlled devaluation to restore competitiveness and relieve pressure. Under a currency board, that option did not exist. The peg was sacred. Breaking it would mean admitting the whole strategy had failed. So the system held the line until the strain was too much. In the early 2000s, the peg finally collapsed. The government defaulted on its debts. Banks shut their doors. People found that the savings they thought were safe were either frozen or suddenly worth far less. Protesters banged pots and pans in the streets. A political crisis followed the monetary one. The same mechanism that had once delivered stability now amplified the crash. Locked into a rigid promise, the system had no way to bend, so it snapped. Currency boards gave Argentina credibility, but they also stripped away the tools that might have softened the fall. Not every currency board ends in such a visible catastrophe. Sometimes the shackles hold, and the system grinds forward year after year. Hong Kong offers a different lens on the same idea. For decades, the Hong Kong dollar has been pegged tightly to the US dollar through a currency board arrangement. The goal was clear: give this small, open, politically sensitive territory a stable, trusted currency so investors would not panic every time the political winds shifted. By that measure, the peg has been a success. It has survived the Asian financial crisis, global recessions, waves of capital flight, and rising political tensions. No sudden devaluations, no hyperinflation, no overnight currency chaos. But the cost shows up in more subtle ways. When US interest rates are near zero, Hong Kong's rates shadow them. Money becomes cheap, capital floods in, real estate prices surge to dizzying heights, asset bubbles grow. Ordinary residents face some of the most expensive housing in the world. When the US raises rates to fight its own inflation, Hong Kong must tighten as well, even if its local economy is already cooling. Borrowing becomes painful. Businesses feel the squeeze. Property markets wobble. Jobs, mortgages, and business cycles in Hong Kong move to the rhythm of a distant central bank making decisions based on American conditions, not local needs. The currency board does not ask, what does Hong Kong need right now? It asks, what does the rule require? This is the quieter side of the shackle. It does not always show itself as collapse. Sometimes it appears as a constant mismatch between the needs of ordinary people and the rhythm imposed by an external anchor. The currency looks calm, life beneath it is not. Currency boards are often presented as the ultimate form of discipline, a way to lock away the bad habits of politicians and give markets something solid to trust. No reckless printing, no surprise devaluation, no sudden experiments, just rules. But the discipline is not as automatic as it appears. If a government cannot print money, it can still borrow heavily in foreign currencies. If it cannot devalue the exchange rate, it can still quietly allow banks and corporations to load up on foreign debt, assuming the peg will never move. If it cannot bail out everyone in theory, it can still offer guarantees in practice, hoping the day of reckoning never arrives. The board disciplines one part of the system, the rest of the machine learns to route around it. You often see the same pattern. The currency board brings stability, capital floods in. Governments and businesses take on more and more foreign debt, comfortable in the belief that the peg is unbreakable. Then a shock hits. Global interest rates rise. A trading partner falls into a recession. Political risk increases. Suddenly, defending the peg requires higher interest rates, painful recessions, and deep spending cuts. At that point, someone must absorb the pain. With a flexible currency, some of that pain would be channeled through a weaker exchange rate and gradual inflation. Under a rigid currency board, the adjustment falls more directly on jobs, wages, and social stability. The currency does not move much, so everything else has to move instead. This raises a harder question. Who actually benefits most from stability enforced this way? On the surface, currency boards are sold as tools for everyone. Stable prices, a strong currency, investor confidence, protection against irresponsible politicians. But look more closely at the distribution of gains. Foreign investors like the predictability. They can lend and invest in a country knowing the exchange rate is anchored to a trusted currency. Local elites with assets abroad appreciate the ability to move money in and out without fearing a sudden collapse of the local unit. Banks and large corporations enjoy lower borrowing costs and easier access to foreign capital. The sharpest edge of the adjustment tends to fall on ordinary workers, small business owners, and local borrowers. When the time comes to defend the peg, they cannot vote for a gentle devaluation or a slower tightening cycle. The decision has already been made by the structure itself. The adjustment shows up instead as factory closures, wage cuts, and unemployment. Under a currency board, the illusion is that politics has been removed from money. In reality, a political choice has already been made to prioritize external credibility and the preferences of capital over the flexibility that might shield local livelihoods in a crisis. That is the deeper truth history keeps pointing back to. Currency boards are not neutral machines. They are political decisions dressed up as technical solutions. A country that adopts a currency board is effectively saying, we would rather promise foreign investors and global markets that we will never break this rule than reserve the right to shield our own citizens with a more flexible policy when the world turns against us. Sometimes that choice is understandable. In a nation scarred by hyperinflation and devaluation, ordinary people may demand a harder anchor. They may even welcome the shackles at first. Anything feels better than another round of savings destroyed by a printing press. But as time passes and new crises hit, the trade-off becomes clearer. Do you defend the peg at any cost, even if it means deep recessions and social unrest? Or do you break it and accept the humiliation and chaos of admitting that the permanent rule was never truly permanent? There is no formula that answers that. The currency board does not solve the underlying dilemma. It only postpones it and makes the eventual decision more dramatic. That is the real story of currency boards. They do not eliminate risk. They concentrate it. They do not abolish politics. They push it into the background until a crisis drags it back into the spotlight. Rigid systems are strong right up until they are not. When pressure builds, they do not bend gracefully. They hold and hold and hold, and then they break. When they do, the damage is rarely shared equally. The next time a government boasts that it has solved its monetary problems by locking its currency to something stronger, it is worth remembering the lessons written again and again in the historical record. It may have bought a period of stability, but it is probably paid with a large piece of its freedom to act. Every crisis reveals the same transfer, from the many who trusted the rule to the few who understood the trade, from those holding paper promises to those holding real assets and real options, from those who believed the peg could never move to those who quietly prepared for the day it might. If this gave you a new perspective, hit subscribe. History has the answers. I will show you where to look.